Renowned economist Peter Schiff recently warned of an impending acceleration in inflation after the release of last month's Consumer Price Index, CPI data.
People who were buying stocks in 2006 had no idea of the magnitude of the financial crisis that would hit the market in 2008. Well, the same people are even more clueless today because the crisis that we're heading for.
In a tweet, Schiff highlighted the unexpected rise in the Consumer Price Index month on month and year on year, indicating that disinflation may end. The December Consumer Price Index data revealed several key points of concern. On a month-on-month basis, the Consumer Price Index rose by 0.3%, exceeding expectations of a 0.2% increase. The year-on-year rise reached 3.4%, slightly surpassing the projected 3.2% increase. Reducing inflation to the target levels of 2.0% in the United States and the Eurozone will be tougher than it has been so far. There are a few reasons for this. First, the job market is strong, which is good, but it also makes it harder to lower inflation. Second, the prices of commodities and materials that industries use will be less helpful in bringing down inflation in the future than in the past. Finally, government spending is expected to be more limited in the coming years. While it will still be expansionary to some extent, it won't be as much as before. This means the government's ability to control inflation through spending will be more limited. Rising inflation can erode savings and disrupt the economy and consumer spending. To prepare for inflation, individuals should diversify investments, budget and save, review debt, and begin investing with a commission-free trading platform and receive up to 15 free stocks worth $2,000. Link in the description. Like, share, and subscribe. Watch the next video.